So kudos to Fed members Steve Myron and Chris Waller for dissenting at today's FOMC meeting in favor of lowering the Fed funds rate by 0.25 percentage point. All right, kudos. The economy is in a disinflationary supply side boom. Growth is strong, but inflation pressures are actually easing. Some quick numbers. Over the past 3 months, the core PCE, personal consumption expenditures, has increased only 2.3% annually and coming down. The 3-month core CPI, 1.6%. Even the top line CPI, only 2.1%. Unit labor costs, wages less productivity, barely above 1% over the past year. That may be the best measure of all. What we have here is a productivity-led economy, and it's counterinflationary. But the Jay Powell Fed won't acknowledge this, never really talk about it. Full cost expensing is spawning a boom in business capital investment, and that's promoting the productivity boom. But the Fed never talks about that either. Meanwhile, energy prices, including gasoline, but all these energy prices that permeate the economy have been coming down for a year. But the Fed never seems to talk about that. Of course, it's all counterinflationary. Meanwhile, for months and months, Jay Powell obsessed about tariff inflation, but so far, none of it materialized. Goods prices, both core and top line, both 12 and 3 months, are below the Fed's 2% target rate. But Mr. Powell no longer talks about that either. Of course, the Fed models are wrong. Growth does not cause inflation. Neither do more people working, causing inflation with a low unemployment rate. Davos, President Trump wanted to know why good economic news seems to always rattle financial markets. But that's because the markets think the Fed will jack up interest rates and stop the boom, even though the historical evidence says that model is completely wrong. David Malpass asks in today's Wall Street Journal why U.S. bond rates have to be so much higher than places like Japan and China when our economy is so much better and our profits and hence our credit is so much stronger. Well, that's a very good question. No doubt, the need for king dollar stability and confidence would help bring down interest rates. Now, just take a look at this 5-year dollar index chart. Just kind of eyeball it, all right? It looks pretty steady around 100 on the index. I don't see a crisis there. Treasury man Scott Bessent reaffirmed a strong dollar policy today. Look, truly, it's time for a change at the Fed. Throw out the models and the bad attitudes about growth and inflation. Please, President Trump, make your Fed choice truly transformational.